Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry, and no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.
It's weekend time, weekly market recap. We got into the middle of February, and by the way, I hope you all have remembered to buy a gift or a present or whatever you bought, if you did, to your beloved partners because it was Valentine's Day just yesterday. So, you know, it's a bit it's a bit cringy at a point. It looks more of a quote unquote festivity to make you going out there and consume more often than not. But hey, it's still a good chance to celebrate and to enjoy, have fun, and share your precious quality time with those you love. So why not? With that out of the way, as usual, let's get into the economic calendar for this week. Real quick, um, there wasn't a lot, but what was there was particularly impactful for markets or for the macro environment as a whole. We started out Monday, really not a lot. We had a few speeches from Trump, but I mean, at this point, you can't realistically expect one single day where Trump doesn't come up with something, right? Then we got Chairman Powell testimony in front of I guess it's a hearing in front of a committee of Congress. So it's something they do annually, and Powell make a little bit of a recap on monetary policies and what the Fed has done and what it plans to do in the future, and a little bit of an assessment on the current conditions of the economy and the Fed policies in response to it in front of Congress. Because at the end of it, everyone needs to report back to Congress in the U.S. Uh, I followed the first one. It was split it in 2 days, I guess, and it was just bullshit. Really. I mean, bunch of bureaucrats which don't understand anything about economics, trying to ask the poor man what he was doing and why, and everything has some sort of a political spin. Like, do you think that what you're facing right now is a direct consequence of the stupid policy Biden implemented, right? And that was, of course, coming from the Republicans, right? And the other side was, do you think the Bidenomics actually helped in this situation? And so could you explain us why we didn't face a recession? It's all credit to what Biden did. So everyone was just trying to cheer up his own team, and it was really awful to watch. And Paul Powell was just trying to give as accurate, again, a quote unquote accurate answers to people which weren't really interested in the economic and monetary aspects of the whole matter, right? So it was cringy, it was stupid. But again, I didn't have anything better to do really, so I watched it for an hour or two. But stupid shit. Um, on Tuesday we got CPI, so we got the headline and the core. The core CPI, which is of course the you should assume it's the most observed from the Fed because they always look at the core, right? Core CPI, core PPI, because they all reflect into the core PCE, and PCE it's what they are looking at to gauge inflation expectations and therefore adjust their policies. A lot of mumbo jumbo, but bottom line is it came in a bit higher than the previous read, but more or less in line with expectations. Maybe a bit hot. I mean, if you consider 10 basis points above the forecast hot, but you can still see the trend to the downside. CPI made a lot of a lot of rumor. It was a lot of fuzz because standing to the press, it came in hot. I mean, it came in hot, maybe a bit hot, but not like hot, hot. It was just 20 basis points above expectations and 10 basis points above the previous read. And if you look at the chart, again, you see that we are not clearly breaking the downward trend to the upside yet. Sure, it's sticky. You could consider it sticky, but I'm going to dive a little bit more into the CPI and the implications and some, trying to put a bit of a light on the shadows that you might encounter if you just focus on the headline. But that's for later. I wanted to relate that to what happened into interest rates and the bonds, right? So for now, let's just look at the headline right here. Or year over year, 3%. So you see, I mean, even right here, like the month over month comes in at 0.5%. The year over year just moved what, 10 basis points from 2.9 up to 3. So again, there are a lot of seasonal adjustments. There are a lot of different math gimmicks which tend to mislead you if you just look at the headline. But that's for later. So a bit more of a Powell testifies, and then more Trump speaks. Don't really care about the GDP in the UK for this week. So we got then to PPE, PPI. A little bit of an Italian pronounce that, right? What was that? 30 basis points for the core, which is lower than the previous read and in line with expectations. And as for the headline PPI, 0.4, 10 basis points above expectations, 10 basis points below previous read, so still downward trajectory. Now, I guess many different folks were focused on PPI because, still a component of the overall index, and it might even be a telltale sign of what's going on. Like you might say, look, if if prices for the producers are going up, then we need to see if they're able to pass it on to the consumers, right? So, if on the other side it's actually going down, that should actually reflect in a lower CPI overall because maybe, producers, they don't need to pass on a lot of inflation to up onto the consumers, right? It could be seen a little bit like that, which is why a lot of people were watching it. And even Bessent, right after the CPI print, Bessent in an interview came in saying, well, I mean, it's not majorly disappointing. It's a bit higher than expected, but we'll see. We'll have a bit more clarity on it when PPI comes in tomorrow. And tomorrow was, of course, Thursday. So they're looking at this data, I guess, to try to anticipate what PCE will be. And I guess PCE is going to come in maybe 2 weeks, something like it. So we'll see. Retail sales, both core and the headline. I think this data is massively bearish, if you ask me. As I always say, this is not adjusted for inflation. So if let's take the retail sales, the headline, right? If it's coming in at minus 90 basis points, and you do consider that the headline CPI was 0.5, if you adjust this one for inflation, it's even worse than what the headline would suggest. So again, retail sales are actually plummeted more than the headline would tell you. It's like when we were looking at it from the standpoint of positive reads, if you remember, I was always saying, yeah, let's say, retail sales came in at 0.3, but CPI was 0.5. That basically means that consumers just paid more to get less when you adjusted it for inflation. Now, if this one goes negative and you have a higher than usual CPI print, the situation is even worse, right? That's the bottom line of it. So, as I said, I'm going to get back to inflation a little bit later on, but for now, let's move to the charts and let's start out with the DXY weekly time frame to start out, just to notice that, we got the initial bounce at this level, which was anticipated, right? but the bounce was kind of faded. And we got now 2 weeks of downside in the DXY, which overall it's not bad for the rest of the world in general. Maybe not so much for Americans, but it's not bad having a DXY which kind of slows down the pace of this up move, because that's when you see the US dollar wrecking ball resonating all across the global economies, right? So a little bit of weakness in the DXY might help other economic actors outside the US, most likely. So now the point is, what's going to be? I mean, we were looking at this macro range. It was looking like we broke out of it, retested the range high, and shoot it to the upside. Now we're having a little bit of a pullback. It's going to be interesting to see if we can retest once again the macro range, or if we're going to collapse back into it and getting a bit more stably, I would say, into the upper quadrant of the macro range. So let's say if over the next 3, 4, 5 weeks you see the DXY coming back down into here, you might expect it to react each of these levels, like 1, 2, potentially 3. There are a few supports. You can't really see them on a weekly time frame, but they are evident if you zoom in on a daily time frame. Like for instance, if you look at this line right here, right, it was support, support, resistance, resistance, resistance broken, retested, confirmed as a support, and up we go. So it might be that if we reapproach this area, it's going to be a bouncy area, at least at first pass. So we'll see where it goes. Fundamentally, I don't think there are many reasons for the DXY to shatter down, but short-term fluctuations on a macro scale can take sometimes weeks. So, just keep on monitoring this one. And bear in mind, at the end of it, having the DXY pulling back is a plus for the overall global economy, because you don't have the majority of the other nations being squeezed, especially on the funding aspect of their economies, because the majority of the funding, it's made in the US dollar denomination. So if you got those funding costs going higher while the economic growth is slowing down outside of the US, that's a double whammy on those economies. So a little bit of a weaker dollar compared to their local currency, it might be a relief for them, right? And in fact, we've seen, like for instance, the euro had a positive week, same as the pound. Um, the pound actually performed a bit better. The euro couldn't really break these highs, at least not yet. Conversely, the Japanese yen pulled back a little bit. It's moving in a way which is completely, I don't want to say inversely correlated, but I might say not correlated with the other major pairs, like for instance the euro, right? Uh, Overall, I mean, if you zoom out, we are still talking about overall weakness in foreign currencies. Why not? But, at least they are getting a bit more stable right here. And as for the dollar Canadian, if you remember, we were saying this pattern right here, this sharp down move, quickly reabsorbed and trading to the other side of the dealing range, usually would suggest a bit more of upside. And we touched right into those levels we were anticipating as a potential target. So essentially foreign currencies, they played out as expected for this week. Not major developments to the upside in the euro or the pound, but the dollar Canadian played out exactly as the pattern would have suggested. Let's have a look at a few of the BRICS. So you see even the Chinese yuan came back up. The ruble is actually, I mean, I don't want to say completely reverted the trend, but this move looks genuine, looks substantial, and it looks like it might have a bit more legs behind it. Double bottom, and it reclaimed this horizontal level right here, retested it, up it goes. So it's not bad. I mean, it looks like a genuine move. Now, we don't really know how much before exhaustion. I think we already touched into levels which could be provide a good deal of resistance. So we'll see. It depends a lot, I guess, on what's going to be, especially the relationships in between the US and Russia. I heard there was some sort of an hour-long call in between Trump and Putin. So maybe if the international and diplomatic relationships in between the two countries would come to a bit more of a softer tone, it might be reflected in the Russian currency as well. We'll see about that. Uh, Even the rupee had a little bit of a bounce. The Brazilian real, it's actually plunging. Hmm. I'm having the doubt I got the chart inverted, but no, I really don't. That's how it's supposed to be quite honest. So, is it? No, I'm not even sure. Let me check this one. That sounds more likely, to be honest. Yeah, yeah. All right. So I guess this is the correct way. When you start inverting these charts at a point, it becomes a mess to remember where you left them. And TradingView doesn't help because sometimes you open back up the application and the combination of Alt plus I, it's a bit all over the place and you don't really remember at first glance if it's right or wrong. But anyway, the Brazilian real, it's coming back up. It was already coming up, so it wasn't bad. It's been like this for a bit more than a month now. Yeah. So not bad for the Brazilian economy, or at least for what concerns the currency. And again, it just reflects a little bit of a pullback in the DXY, right? So currencies, they are trying to put themselves together. That's how I would assess them. Now, let's move on to Bitcoin first, because this is a really quick one. Nothing happened. Literally nothing. I mean, we are still hovering around this level, but it's not really going anywhere. It looks like a trapped fractal, if you want to call it that. It's much more evident if you look at it on a lower time frame. So it's basically stuck in between this lower fractal right here, right, and this upper fractal, which could be this one right here. So it's not really going anywhere. I would say up until the point we can clearly either reclaim or break through one of these two, we are going to stay range bound for now. So it's going to be boring, or at least has been boring. But if you have a little bit of familiarity with Bitcoin, you do know that it goes through these long periods of consolidation before it explodes one way or the other. And, it's a consistent pattern. It goes really quiet, really boring, and everyone kind of loses interest up until the point it just rip one way or the other. Such is the nature of the asset. So not a lot for Bitcoin. So let's move into gold because gold was interesting. If you remember before pulling up the chart, if you remember last week, we were looking at a particular level. Let's check that out. I don't really see any particular issue with gold. We touched into the 2,900 level on the future. We are getting close to a big figure, psychological level, 3,000. So again, you know how the market likes to treat these big psychological levels. Might see a bit of a volatility spike, or I mean, usually, oftentimes you either see a front run of the level or a completely overshoot. It's kind of rare that we stop right at the level. It could happen, of course, but maybe what I'm trying to say, it's just it wouldn't be a bad time to book in some profits if you have it. And as you can see, we kind of hit the level. We got up to 2,900 and almost 70. Let's round it up to 70. It was actually 68.5, but it doesn't really change a lot on a macro perspective. And we closed on Friday with a very negative day. From open to close, it was down a bit more than 2%, which again, in the grand scheme of things, it's not really a huge deal. It's just a healthy pullback, maybe. We have seen it in the past. But the logic sticks that when you get close to big psychological levels, what you tend to see, as I said, it might be a little bit of a front run or an overshoot. In this case, it looks like we front run the level a little bit. Now, does it mean oil is doomed? Sorry, gold is doomed, and the bull market in gold, it's over? No, it just means we might have a little bit of a pullback. It could try to reaccumulate at a level, at a point. So now the question would be, where is that level? How much could we pull back? I mean, the weekly closed down with a little bit of a, you want to call it a shooting star? I wouldn't, but a bit of a rejection at this level. So it might be we take a bit of time consolidating and reaccumulating. There are a few interesting points where you might be interested in adding if you think it's still on an upward trajectory. One, I mean, the most obvious would be these, and really all these region in between 2,800 and 2,750, more or less. But you might see sporadic bounces around this level right here. Maybe I'd say there might be a little bit of a structure there. Well, yeah, maybe here. It was kind of already retested though. So the good thing about it is that the up move was particularly structured and ordered. So that's usually a sign of strength because the market is building up its way to the upside. So it's not like we got a huge spike to the upside, and we are left prone to a sharp pullback because the move was inefficient. And really, every piece of inefficient move to the upside, like this one, was quickly rebalanced, and we pumped again. We rebalanced, and it pumped again. And even this one right here, pump, rebalance, or backfill, or drew back, whatever you want to call it, up it goes. So, I mean, we are in the process of kind of probably breaking this momentum to the upside, or maybe we already broke it. So we might see it shifting from, an upside push to a little bit of a consolidation. And then we'll see if that consolidation turns out to be a redistribution and therefore a much deeper retracement, or if we can just hover around these levels right here in this area and building up a new base to fuel a future up move. You're never sure about the timing in these instances. It could take 2 weeks, it could take a month, nobody knows. Just mark off a few levels and go off of them, just to give you a bit of a guidance if you're looking at it on a daily or a weekly time frame, right? That's where I would leave it for now. So let's now transition into oil because there are a few points about oil which might be interesting to notice. But before that, let's remember what the assessment for oil was last week. I might say it could keep on trading sideways for a while, maybe a few spikes to the upside, a few attempts to push a bit more, a bit deeper into this level right here. But I would still be kind of neutral on oil. And lo and behold, oil started out the week with a bit of an upside move, but then, after hitting back into what you could consider, at this point, a resistance because it was a little bit of a base which was broken. Now we retested back into it and we was rejected. So, we got both, right? We got this spike, quote unquote, to the upside, and the further attempt of pushing deeper into the level. Still didn't break it, but not a very strong close for the week on oil. Like if you zoom out and you look at the weekly time frame, I mean, it's not a very good candle for it. Still, at support, if you consider this a weekly point of release, but it's kind of like it touched it into here, it bounced, and now it's back down there again. So, the reaction was provided, and then if price cannot be sustained for an upside move, it starts to depict a green type of a scenario for oil, again, which is in line with the overall fundamental thesis I ever had for really more than 2 years at this point. Which again, it doesn't mean it's going to play out exactly as I imagine it, or it doesn't mean it's going to play out at all. I'm just saying, for now, I keep on standing on that ground, and I keep on holding my ground as for lower prices in oil. Um, it's just, if you look at the macro data, I don't see a global economy strong enough to support it. And if you look at the demand side of oil, I mean, we have seen throughout the last 2 years, 2023, 2024, especially demand from China really went down like a lot. Other major oil buyers stayed pretty much where they were. Um, the rest of the world actually, I think, relative to China, increased the demand. But China was a huge buyer of oil, and if you got a major buyer like that stepping out, of course it's going to impact price. And again, still in a, how would you want to call it, in an environment where major producers in the Middle East are still cutting supply or not bringing back online the supply they cut before. So, not cool for oil. Another piece of news on oil might be that if you had a look at Chevron, which is one of the main energy producers in the US, Chevron announced job cuts for 20% of the staff. So, I mean, that is substantial. Also, because this is good paying jobs. So if you start to lose them, it's not good overall in aggregate demand, because you lose very substantial wages with a lot of potential purchasing power, right? So again, why are we seeing a big company like Chevron cutting heads at this point? Might be you find a few evidences of it in what the gasoline futures are doing. So if you check from a seasonality standpoint, we should be in a period where you see gasoline price going higher. Maybe not, sharply higher like it was, let's say, in 2021, but I mean, a bit of a grind to the upside like it was in 2022 or in 2023, where it grinded to the upside and it got that little bit of a spike throughout the winter, and then prices got back down and stabilized lower. But from a seasonality standpoint, you should see a little bit of that, and we didn't see it. So it might be that this dynamic, which didn't play out this year as the previous years, kind of impacted in a negative way on Chevron revenues, and therefore now, in order to maintain their margins, they need to cut on the costs. And as we well know, the simple way to cut costs, it's cutting heads, because you can't really cut on a lot of other fixed expenses that you have as a company. I mean, you still have to pay if you are renting something like a building or an infrastructure. You can't cut on your funding. Let's say you got mortgages or you got loans. It's not like you can cut on those expenses. You still have to, to face the down payments, right? And you can't really cut on energy. I mean, even if you are an energy producer, you're still consuming a bit of energy to run the machinery that you use to extract the commodities, more or less, right? So you can't really cut them out. Otherwise, you're not going to be able to extract the commodities that are your core business in the end. So it might be a little bit of that. And it's going to be interesting to see that, because that it's going to impact inflation, or the CPI, so to speak, on two sides. Of course, the prices overall are impacted by the energy costs, because energy is reflected in everything down the supply chain, and from an aggregate demand standpoint, because if they cut heads, that means less wages, less purchasing power potentially, and therefore less aggregate demand overall. So that was a good. I mean, I don't know if it's good or bad per se. It's just interesting to notice, right? But there is another thing which that is interesting. If you remember the break evens, now throughout all these down move and overall weakness in oil, the break evens are keeping on climbing to the upside. And you might say, so what's the deal here? I mean, we were used to think at the break evens as some sort of a leading indicator, and now we are looking at these massive divergence, which it should mean that at a point, if you look at it from a traditional standpoint, and the traditional way of looking at the indicator, that should mean that overall, at a point, oil prices should kind of catch up to the upside with the inflation expectations represented by the break evens. But if you remember, I already told you 2 times over the last month, in this particular case, I'm kind of discarding the signal given by the break evens for mainly 2 reasons. All right. Because I'm not particularly sure, and I'm just trying to apply a little bit of a logic. It's not backed by any type of hard data. It's just my thought experiment, right? But I'm thinking, if these charts right here, they plotted the way they are, and they are reflecting inflation expectations into the future, now I'm starting to wonder, it might be that these divergence we are looking at could, it could be true on both sides. And what do I mean? It could be true that inflation expectations are going higher, but maybe not, because people are expecting further inflation due to an energy spike or an energy cost and price spike, if you get what I mean. For instance, it could be inflation expectations are going higher, let's say because of tariffs, right? What happens if you implement tariffs for real? What's going to happen? The mainstream media would tell you that it's going to be inflationary, at least in the short term, because, of course, a tariff is a tax on import. So, that tax will be initially faced by the importers, and then they're going to pass it on to the consumers. All right, so the consumers will see higher prices and therefore higher inflation expectations reflected in the break evens, which it's one way to look at it. But it is also true that, as we said many, many times, the consumers are a bit tapped out. So if they can't chase prices higher and higher, what's going to happen? Well, they're going to pull back and stop consuming that particular or particular items. It could be one, could be two, it could be a bunch, it could be a basket. We don't know yet, because we don't know how and when and on what tariffs will be implemented, right? But let's say, it's just a base case, right? Hypothetical. But, if they are tapped out, they're going to stop consuming that, and therefore you're going to lose demand. So those prices cannot really go higher than that. So, again, we are talking expectations here, but we are not really facing a lot of economic realities. We are just dealing with hypotheticals so far, and it's really hard to predict what's going to happen. So I think a lot of what is reflected in these charts right here, it's just probably fear of something which never came so far, has been threatened, and we don't know for a fact the potential impacts on consumer prices, the real economy as a whole. It could also be that if you implement tariffs on XYZ goods coming from abroad, from the rest of the world into the US, it could also be that if consumers can't really chase price higher, or if the importer cannot really pass those price increases on to the consumers, they're going to just stop importing that shit. And guess what? If you stop importing them, there's going to be a contraction in the domestic supply of those goods. Therefore, all else being equal, if the supply shrinks and the demand stay constant, you're going to see price going up in those goods. That's another way of looking at it. Again, is it true? Is it not? You could also say, yeah, I mean, it doesn't make any difference whether they import the goods or not, because, as we've seen, consumers are already tapped out, so they can't really keep up with price increases, so they're not going to buy them anyway. So they import less because people are demanding and consuming less of it because prices are too high. So the only way to reconcile the entire dynamic is for prices to come back down. I'm not sitting here pretending that I know exactly how it's going to play out and if it's going to play out one way or the other. I'm just saying there are cases to be built up on both sides of this fence. And just watching the mainstream media telling you that, well, yeah, we're going to have inflation because of tariffs, or maybe not, right? Or, oil should spike to the upside because inflation expectations are so high. Yeah, but maybe they're not tied to some economic reality in the energy market. Maybe they are more tied to some fear in the geopolitical landscape. So, and anyway, there are expectations. So again, how do you reconcile that? You could also say that all those surveys about inflation expectations right now, they are completely garbage because as we have seen in the past, they are very highly influenced by the political view of the interviewer. Sorry, the people interviewed. I mean, I don't know where inflation is going to go. I don't know what I should expect. I only know that I don't like Trump. And since now Trump is in office, I'm expecting inflation to go higher just because I think Trump is stupid and it's going to fuck up the economy of the country because I don't like him. Whether if I'm instead I'm a Republican which voted for Trump, I don't know where inflation is going to go either, and for what reasons. I just know that the guy I voted for and the guy I like is in office right now, and everything he does, no matter what it is, it's going to be good. Therefore, inflation is going to be down into the future. So as you can see, there is no economic reality bearing up these surveys. It's just political views and opinions. So you could also say those are flawed too right now, and it's kind of pointless to look at them and imagine to have a serious type of a predictive capability into those indicators, right? So I'm just defaulting back to price and price alone, and overall fundamentals in the macroeconomy as for aggregate demand to grasp what I should think or where I should put the more odds for the price of oil to go this direction or the other. And to close it down, as for now, I think the most likely direction, it's still lower. Not a crash, but still a little bit of a grind to the downside. And that would be my take, which, if you notice, it really never changed. Even throughout these spikes to the upside, I've always been like, yeah, I mean, think it's not going to live longer, right? So that would be it for oil. So now we are going to step back a little bit to the economic calendar, and we're going to look at a little bit of the last inflation CPI print, and then check the yields and the bonds and the potential relationships in between the two and the discrepancies in this data which just came in on Wednesday. So back to inflation as promised, just to remember the data came in at 0.5% for the month over month and 3% for the year over year rate. And already some folks might ask, why such a huge, I mean, everyone was talking about being hot. So why such a huge increment in the month over month read didn't actually lead in a huge increment in the year over year type of read? Well, I mean, I don't have a precise answer to it. Just be aware that when you compare these different data, you need to account for seasonal adjustments and something like the base effect that you get year over year. So, I mean, there are always adjustments and the math is a bit skewed one way or the other sometimes. Not to mention, as I always say, that it might surprise you, but a lot of times these data are just made up to fit what you want to see in them, or what you wanted to transmit to the market. I know it sounds a bit fudgy, and I know it sounds crazy, but uh, there are evidences that oftentimes the data just don't add up. And we always hide ourselves behind adjustments, quote unquote. So I mean, beyond that, I don't want to get conspiratorial here, but for instance, let's just look at what the yields did throughout this week. They were already bouncing up Monday, Tuesday. The CPI report came in and they spiked to the upside on basically all of the different parts of the curve you can look at. So the long end right here, the medium part of the curve, and the short end of the curve. Now, they almost completely reversed on Thursday and Friday. Why it might be? Well, look, before digging into it, just let's try to clarify a point. People always say that the Fed only controls the short end of the curve, while the medium and long end are much more influenced by pure market forces, which is true, right? But I mean, it is also true that even the short end might be influenced by market forces. We are used to believe that just because the Fed sets the Fed funds rate, so the overnight rate, then consequentially treasuries at the short end of the curve should be impacted, and should their yield should be determined by what the Fed does, which is not completely true nor completely accurate when you think about it. Because I mean, look, the Treasury actually issues the bonds, all the bonds, from the long bonds to the very short-term bonds, like your T-bills. But at the end of it, those treasuries have to be put into the market. And how does it work? I mean, you got primary dealers showing up at the auction, and they buy the treasuries from the Treasury, wink, wink, not, not. And then they actually are responsible to relocate them in the open market. All right. And the prerogative of a primary dealer is that they are forced to buy the treasuries when they are issued. They can't really refuse to buy them. They have to. Now, it is also true that while they are buying it, since it is an auction, they can reflect market desires by acting in a way which at the end results in a higher, slightly higher, or slightly lower yield at the auction. So it's not completely correct to say that the market doesn't have an impact on the short end of the curve and everything is on the Fed. All right. So first point cleared out. Now, if we want to have a look at the recent CPI print and how it could be a little bit, just a little bit misleading in my view, I usually keep this layout right here where I do want to look at the 10-year yield, the DXY, Fed funds, and the year-over-year CPI. Now, why would you include the DXY? Well, because at the end of it, for US domestic inflation, having the dollar, which is much more stronger than the rest of the other currencies, is actually something which keeps inflation at bay. So it's hard to expect wildly inflationary environment if you have the DXY going to the upside. It doesn't mean that you're not going to have inflation. It just means that it's going to be better than it would otherwise be. All right, just to explain why I keep it there. But look, the inflation read, it's influenced by many different things. All right, and a few factors might be structural, other factors might be just temporary. For instance, we have seen in the US we got hurricanes, then you got the fires in California, the wildfires in California, and everything is burning down. So when you think of a natural disaster like that, naturally that leads to higher prices because people need to spend money. And if it's not people, it might be the government, it might be the local state, it might be whoever, but money needs to be spent in order to rebuild what has been destroyed. All right. Now, although it might cause a little bit of a bip to the upside in inflation or CPI in the short term, over the long run, that is not actually structurally inflationary. And if you don't believe me, you could just read a paragraph or two about the broken window type of dynamic. I don't remember who written it, but I mean, it shows you how those short-term fluctuations usually resolve themselves in a much subdued pace of inflation to the upside in the long run, because those resources that have been spent on rebuilding have been not deployed in productive investments, or they didn't really go in the real economy fueling the growth, right? They were diverted to something else which wasn't really planned. It was some sort of an emergency. So overall, they are a drag on economic growth and therefore inflation over the long run. So first point. Then other factors which might impact the overall data just in the short term, it could be, for instance, we've seen a lot of fuzz around the transportation component of the CPI. And why is that? I mean, we already established that gasoline it's not where it should be from a seasonality standpoint. So what was it? Well, it was insurance. Insurance, auto insurance went up massively recently. And it's not the first time it happens, to be fair. It looks like over the last 2 or 3 years, it happened pretty much every time at the beginning of the year. Now, you might wonder why. Well, because that's when your insurance contract actually adjusts and the insurance company actually revalue the contract and the premium that you need to pay in order to be covered, and therefore they can adjust the price. It happens just one time, and usually it's in January, right? So it's not something which is sustained. I mean, you got that bump once a year and then it's done, right? So that could be another one. Then, of course, you got the stuff which might be more ridiculous, like I don't know if it's an appropriate term, but I called it the Eggsmageddon because you've seen, because of the bird flu, a lot of chicken have been put down because there was a risk for the safety of the citizens and the food they could potentially have been eaten. So, what's going to happen if you smash down the supply of chickens and therefore the potential eggs produced? You're going to have a supply demand imbalance. Therefore, the price of chicken and eggs, it might go to the upside. But I mean, is it a structural problem? Is it to say that from here on out, for the next 6, 9, 12, 18 months, you're not going to have any increase in the supply of chicken or eggs in the United States? I would say no, it's not. So again, it might contribute to a little bit of a bump in an inflation rate for this month, but it's not something which it's going to stay with you forever, right? So at the end of the day, many different factors like these can actually, I don't want to say invalidate the read, but they can give you a mislead type of indication. Overall, I mean, the headline for this month, it was a bit higher than expected, of course, and it was high compared to what the overall reads have been over the last few months. But look, if you look at what might be more structural for real, like for instance shelter, and when you think about shelter, it's not just rent. It's rent, it's property taxes, it's maintenance, so it's your mortgages, down payments, right? It's your electricity bills, whatever you need to pay in order to be able to keep your house and keep it functional, right? So that represents 60% of the increase in CPI, right? And although it was particularly stubborn and it was particularly sticky to the upside, you also need to consider that it lags like a lot. So if you would take, instead of the data the BLS or any other government agency is providing right now, and kind of erase that log and take a look at much more real-time market data, you would see that the headline CPI would be probably around 2% instead of 3 or 3.3. All right. And that's one thing which could really impact the trend of inflation and therefore the CPI in the coming months, right? Then um, you might also want to check stuff like, the threat of tariffs. Look, it doesn't really matter whether these tariffs have been implemented and then they have been pushed back and then they are in some sort of a pause. They're in a limbo. We don't know if we are going to have them in another 15, 20 days, or if they're not going to be implemented. Nobody knows at this point. But what might happen, and actually the ISM confirmed it, is that people, just because they are scared about potential price increases in the future, they're going to stockpile on stuff now. And not only people, but companies and business as well. So you load up your inventory now because you don't want to take the chance of having to pay higher prices in a month or two because of tariffs, which could or could not be implemented. What happens is, if everyone is rushing into buying stuff now, they're gonna pull forward aggregate demand, therefore fueling what? Potential inflation, right? So, I mean, at the end of it, when you take a look at the long-term trend of inflation, you see that although we might have had a bit of an uptick, we are still in some sort of a range in between 2 and 3%. And there are not really a lot of factors which could indicate a sustained pace to the upside for inflation. That's, I guess, the main takeaway here, right? So, if you want to have even more evidences of it, or at least, if not evidences, a little bit more clarity, you could just try to look at the CPI index and look how it is decomposed, and look at the different components and how did they trend over the last 2, 3, 4 months, and seeing if, each component is trending one way or the other, and what type of an impact it has on the overall CPI number. It might be something which opened your eyes, because once you figure out which sectors or slash components of the index are much more impactful on the final number, on the headline, and you figure out where's the trend for those components which are really impacting the index, then you might have a little bit more fair assessment of it. And ultimately, and when I found out, it was, I mean, I honestly, I just laughed, because I do remember back then when everyone was looking at CPI going from 3 to 9% in 2021, 22, and everyone was really pulling their hair, because they were like, yeah, I mean, they say 9%. Reality it's much higher than that, because we do know that CPI, it's really CPI, so they're giving us a number, but the actual inflation is much higher than that. And you just need to go on a website which is called Trueflation to see where the actual rate of inflation is. Which, I mean, fair. Trueflation, I think, is actually a legit site. It's different from the headline CPI, because the measurements they are more in real time. They update those prices in real time every single day. They monitor a much bigger basket of items and services. So, I mean, you could quite honestly say they are much more accurate in establishing the real rate of inflation. But if you go down that path when inflation is going up, right, you should also admit that the same logic applies when inflation is going down. And it just so happened that right now, Trueflation, it's giving an inflation rate of 2.1%, I guess. So, I mean, CPI came in at 3, but through inflation it's giving you a 2. So now, how do you reconcile this cognitive dissonance? It cannot be true just when it's going to the upside and not being true when it's going to the downside. Otherwise, you're just cherry picking the data, I guess. And not only that, but there was this nice relationship in between the trueflation reads and the BLS read for the CPI. And what happened is that basically over the last 4 or 5 years, trueflation actually lead the BLS numbers, where something like a month and a half type of a lag. If you factor that lag in, at this point, if the read for trueflation is 2.10%, you should expect CPI as measured by the BLS to come back down over the next month or two. So basically April, maybe, all right? And so again, then you tell me if you're looking at genuine inflation, sustaining inflation going out of control. I Again, I don't think so, and I think these yields, these rates, eventually, sooner or later, I don't know what the catalyst might be, but they're gonna come back down at a point. I'm still positive on that thesis, so to speak. All right. So conversely, if you look at what the bonds and the treasuries did, pretty much what was expected. A little bit of volatility, like if you think of the TLT, I was looking at it and saying, well, it's probably going to stay in this range, in between this level at 90 and probably this level around 88. Turned out it spiked down toward 87, but it closed down the week basically in the middle of the previous range identified. So yeah, a little bit of volatility because of the data, because of the uncertainty, but at the end of it, I mean, let's look at it on a weekly time frame. Here's where the previous week closed, and here's where this week closed. I mean, we are looking at what? 89.27, 89.15. I mean, like 15 basis points. I mean, I know these are not basis points, but just 15 decimal points, let's call it that. And the medium and the end of the curve, it's actually it closed a bit higher than that, and the short end was range bound. So not a lot of movement, a lot of intra-week volatility, but not a lot of movements. There's one thing which I think was a curiosity in my view out of bonds and treasuries, because I do remember one of the main claims, Scott Bessent, which is the new Treasury Secretary, right? One of the main things he said while he was still campaigning with Trump and Yellen was still in office, he was criticizing Yellen because throughout those periods of very low rates, she wasn't issuing treasuries at the long end. And so Bessent theory is that was a wonderful period to lock in those lower rates and issue debt at the medium and long term end of the curve so that we grant ourselves funding at a very low cost. Which, I mean, you can't really argue with that type of logic, but it is also true that it's particularly easy to pontificate when you're not in office. And it turns out, if you check recent Bessent's claims or interviews, he's actually saying now that, well, I mean, yeah, it's true. I criticized her, but I think we're going to keep on issuing the same amount of bills she was doing now that I'm in office. You might say, maybe now he found out something he didn't know before. The reality is that T-bills are the backbones of the monetary system, the way the monetary system is structured. So the second you step into office saying, yeah, well, you know what, I'm going to stop issuing T-bills, 5 minutes later, you get a call from Jamie Dimon, and he says, listen, Mr. Whatever the fuck, if you don't know how this shit works, I'ma tell you, if you stop issuing T-bills now, the whole house of cards just crumbles. And it's not going to be a problem for the emerging markets. We are going to be hit quite substantially. So don't fucking do it. And immediately, Besson immediately reversed course. It was just a curiosity. I mean, it could also be that in that interview, actually, he also said that although initially the press was trying to build up this potential war in between the White House and the Fed, and in between Trump, which was demanding lower rates, and Powell, which was more on the side of, well, we will assess it as we go. So I'm not discarding the possibility that rates will stay where they are for now. Now the platform seems to be shifted toward, well, I mean, we don't really need the Fed to bring rates lower, because with the good job Elon Musk is doing with the Doge and cutting off all these stupid spending, unnecessary spending, inefficient spending, it might be that if we can really reduce the spending and the debt and the deficit, the market just naturally will ask, or will demand, or will be happy with lower yields, because all of a sudden we don't look like that stupid and silly drunken sailor which is spending money like there's no tomorrow. And maybe the market will compensate us for being responsible and getting back to a little bit more of fiscal responsibility, which could be true. I mean, I'm not here to deny or confirm that thesis. I think, it's an argument. It might be as good as anyone else, but still, it provides a little bit of a different logic to it. And of course, it actually resolves the potential issues in between the White House and the Fed before they actually start. So, not bad, right? And talking about government spending, I I stumble upon, I guess it's an online betting platform. I don't really know it. I guess it's called Kalshi or something. But it was interesting because now they are uh, pricing in a above 60% chance that we are going to see a government shutdown this year for the United States. I'm not going to explain what a government shutdown is, just Google it, but it ties in with the public and government spending. So if there is a shutdown, there's no more spending. And if it's true that government spending it's or has been what fueled growth in the United States while the rest of the world was really struggling, if you remove the government spending, you remove the support for growth and inflation, by the way. So another point for disinflation down the road. And the whole thing actually took a little bit of a political spin, all right? Because I was reading, Elon Musk right now, it's really pissing off a lot of folks, and most likely powerful folks. If you don't know it, just go online, just read what the Doge is doing with USAID, the implications with how USAID was funding media, Politico, and how it was used to basically everything other than aid to other subdeveloped economies and whatnot. So there is a huge rabbit hole there, but the bottom line might be that if we get to the point where the Congress needs to pass a bill to, as they usually do, to increase the debt ceiling and avoid the shutdown, it might be that because of the tensions that the Doge activity, the whole stand the Trump administration took on those matters, it could be that, instead of being a bipartisan agreement, this time around, the Democrats might say, you know what, we're not going to vote for it. So, good luck, because that would show that you don't actually have that strong majority you thought you had. And I already mentioned it in the past, but among the Republican ranks, there is also this Freedom Caucus, which has always been particularly vocal on the need of reducing government spending. So again, it might be another pieces of the puzzle that at the end of the day it's going to be missing when it comes down to vote on these very delicate topics. And the Trump majority, at least for this topic, might be a bit less unsure than what the tycoon is thinking of, right? But it impacts the overall government spending at the end of the day. So, if you get to these uh, fiscal policy type of freeze, what's going to happen is that you're not going to have government money flowing into the economy, and therefore, on one hand, less money are being spent. On the other hand, the Fed is a little bit stuck in between, the rock and the hard place, or whatever it was, the hammer and the hard place, whatever. So, they can't really lower rates, assuming it works, which it doesn't. The government, it's inabilitated to spend money. What do you think is going to happen to growth and inflation therefore? All right. So just a few things to put and to shed a little bit of clarity and light because there were, as you can see, a lot of shadows. I'm not saying that everything that you read in the mainstream media is completely garbage. I'm just saying that more often than not, and I would go as far as saying that 95% of the cases, there's always a lot more to it than what the headline would suggest. So this is why it's important to actually read the headline and then digging into it and see what the implications might be and what it might be under the hood. And again, everything is translated after a while in the price action because all the things I've just mentioned, I'm not saying it for sure, but just imagine the headline came in, the reaction was this spike, and then you give a market 24 hours to wrap his head around what just came out. It might go through the same logic I just displayed here, and you see a reversal in yields, at least for the week, all right? For the week. Not talking next month, next quarter, semester, but for this week. So if you read the headline and you just think, yeah, I mean, that's a good time to go short the bonds. No, 2 days after you're out. So again, don't trade the headlines up until the point you don't really understand them. And always remember, other guys out there, they spend a lot of money to be able to be ahead of you when it comes down to actually decipher the news and the data. They got them empowered, they got the funds, they got the structure, they got everything. So don't trade off of the headlines. You're gonna be fucked more often than not. I'm gonna tell you that. Right? So that closes the chapter on rates, inflation, bonds, and whatnot, and the CP lie. People loves to like it to call it the CP lie, don't they? So let's have a look at stocks, and then we're gonna finish up. On to stocks, real quick or relatively quick, we hope. So, I mean, the charts are particularly good this week. I mean, after a little bit of a consolidation and a few choppy days with major scares, it looks like at least IQ Futures managed to maybe, just maybe, resolve this long consolidation and trying to take a run at the highs. We'll see next week. ES are lagging a little bit behind, but still they are really near the all-time highs. So from a market structure standpoint, there is no evident risk here, at least for now. If there are risks, they're going to come from the fundamental side or the positioning side or some sort of a credit event, whatever. But as for the price action, we don't see anything which would suggest an immediate need to be worried. All right. The Dow is holding up relatively well. It came up very sharply. It's now consolidating at a higher level. I would expect the Dow to soften a bit if NQ really starts to run to the upside. I've noticed that oftentimes when you see the Dow being particularly impulsive to the upside, there is a little bit of a rotation in place, and you might see the others, you know, as we've seen, consolidating a bit, not really crashing, but it just, market rotation, money flows into these other index, and these other two are maybe a bit more dried out of liquidity. No need to tell that if there is one which is underperforming, as usual, it's the Russell, so the small caps. No surprises there. I mean, if you want to stock pick a few companies here and there in the small caps, you're free to do that, but um, wouldn't really be my optimal game plan if you ask me. But again, you're free to do whatever you want. Switching layout, still we're looking at ES and NQ. Again, as we said last week, a lot of scares with the DeepSeek type of dump, with the tariffs on Mexico and Canada. But at the end of it, moving averages are all to the upside, upward sloped, the faster above the medium and the slower. So, you're even looking at the stochastic turning to the upside. So that would suggest momentum gaining, or gained, that's correct term, momentum gain to the upside. As for ES, while it's starting to break out of a range, and same for the NQ futures for now. These cross to the upside actually came in around the 60 level, which would suggest we are maintaining a little bit more of a bullish posture. Again, from a TA standpoint, you can talk about the risks as much as you want, but up until the point you don't see them reflected into the price action, don't go blindly short these markets. You don't know how irrational they might get. All right. The ETFs are kind of the same story. No real differences in between these and the futures. So, I mean, at the end of it, stocks are particularly good for now. I'm not going to dive into the individual stocks this week. We got no time for it. The video is already too long. So let's just have a look at a few potential risks, just very briefly. Not going to spend a lot of time on them. The first one might be what is called the Sharpe ratio. It's a 1 year measurement, and they actually take a 6 month average of it, and it should kind of be some sort of a leading indicator for the stock market as for the positive momentum or the negative momentum. And it looks like we had a pretty much extended bull market for now, and it might be this indicator is now throwing a bit of red signals, which again doesn't mean the market is going to crash 50-40%. It could be just we are going to see subdued returns, or a much more stagnant type of market in the next months. We don't know yet. We'll see. But still, is another type of a blip on your radar when it comes down to assessing potential risks if you are exposed in the stock market. On the other hand, if you check, for instance, retail sentiment as measured by JP Morgan in this case, it looks like sentiment is particularly high, which is again on the surface, it might be, yeah, well, so all cool, everyone feeling good, so we can only go up from here. Well, I mean, yeah, but usually retails are actually the most bullish and the more positive at market tops. Might be local tops, it doesn't have to be the start of a secular bear market, just still be aware of REITs like these, all right? And, they're also putting the money where their mouth is. So they're feeling positive, they're feeling confident. I would also call it a little bit some sort of a complacency. And if you look at the inflows from the retailer, they're actually picking up substantially right now. So not only they are showing a good sentiment, but they're also putting money in. And now in this case, we are just looking at Nvidia, for instance, because it was that one stock which took the biggest hit throughout the DeepSeek type of dump. But retail investors are just buying the dip. So again, good for them and good for you if you were positioned well ahead of it, right? Now, on the other side, though, although they feel particularly positive and although they are throwing money at it, standing to the University of Michigan survey as for the expected household income for the next year, it looks like expectations for household income are particularly low. So there is a little bit of a discrepancy there because, I mean, you feel like your income is going to go down or it's going to stay low, but at the same time, you're taking on risks in the financial markets. I would say that the way you reconcile that is that, retail investors and people which are suffering job losses or hours, working hours being cut, they are not necessarily the same chunk of the population, right? I mean, if you think about many different people which might be in difficulties, financial difficulties or uh, employment type of difficulties, most likely they are not the ones which are throwing money at the stock market because they don't have the money. They're living paycheck to paycheck. So this might be one way by which you can reconcile this sort of a discrepancy in between the two data set. All right. An interesting view is what Bloomberg is offering right here when it comes down to credit spread. Although credit spread are particularly low right now, it is also true that if you look at the earnings yield as for the S&P 500 relative to the corporate bonds yield, I mean, it looks like there is a little bit of an ominous signal right there because last time uh, this ratio was at these levels, well, that was right ahead of 2008. So, you know, it's it's another bit on the radar. So just pay attention to it. The logic might be uh, why, I mean, why would you think that triple B yields, triple B corporate bonds, are they yielding you more than earnings yielding stocks? So I mean, there are good competition for stocks. So if you're holding stocks, you're not doing it for the dividends. You're doing it for what? Price appreciation. As for the assets, so you're really just speculating, not betting on the fundamentals, but just speculating on market movements. So again, that might be one way of saying it. Quite honestly, I'm not particularly sure that's the correct way. It's just the first one on top of my head. One thing is that when, and in the eventuality where all these people which have been piled in to these corporate bonds, when they need to look for an exit, probably they're gonna be, you know, indiscriminate sellers trying to sell to very discriminating buyers. I mean, the buyers which supposedly should just lift the offer, they're going to have a lot of questions on these corporate bonds. So, I mean, if you check what happened in the past, you might see that it doesn't play out really well when it does, or at least when it moves in that direction. So, again, although credit spreads might be very low, usually when they are very very low, there is just one way where they can go next. I'm not saying it's tomorrow, next week, next month. It's just pay attention to it again. It is also true that many people are noticing now that volatility, we are seeing more frequent spikes in volatility, and volatility it's kind of slowly grinding to the upside. Now, it might be true, it might be not. I think it's too early to tell because people are trying to relate it to the Trump administration stepping in. All right. What is for sure is that usually you see the stock market really going to the upside when volatility is subdued, and volatility really comes in and spikes when you got market pullbacks, corrections, or actual crashes. So if there is one thing you can know about volatility is that by design it contracts and then it expands and it goes in a cycle. So if you see volatility starting to to maintain itself at higher levels. And if these spikes in the VIX keeps on being particularly frequent, that might be a drag on the future growth of the stock market. As for the price appreciation, of course. So just keep in mind it might play a role, especially in these 2025 with all the geopolitical uncertainties, the economic uncertainties, and whatnot. So we are living through times where many different things might change, and therefore markets might need to discount that type of uncertainty. All right. Also because the VIX, it's particularly correlated with what Fed funds does. All right. And for obvious reasons, you see the VIX spiking to the upside, and the Fed, in that particular instance, it's dropping rates like there is no tomorrow. Why, you might ask? Well, they drop rates because the market is broken. So still same type of relationship there. So again, I mean, this market currently, it's not a market you want to short. And if you need any other proof, right, we've just had two. DeepSeek AI bubble popped. Nope. We keep on going higher. We buy the dip. All right. Tariffs, inflation skyrocketing, supply chains broken, massive economic damage. Shrug it off. We keep on buying, and it goes up. So I mean, it's the usual old saying: don't fight the tape. You don't fight the tape in these markets up until the point you got clear evidences and clear structural breaks. You can't just blindly short these markets and expect to make money. It might go well for like 1 week or two, but eventually you really take the chance of being smoked by an upside move. So just give it time. I mean, if you're one of those perma bears, I mean, your moment to shine will come, but most likely this is not it. All right. So just be patient. Now, with all these, don't want to call it giga bullish type of argumentation, but all in all, just remember, since as I stated in the beginning of the video, we are at the middle of February. Just remember that the second half of February, from a seasonality standpoint, it tends to be a bit weaker for the equity market. So again, does it mean we are going to crash? No, it might just mean we could keep on seeing the same behavior we've seen so far, with markets with just going over at the end of it. And then we'll see how the month closes in and what's going to come in March. But, for now, this is the situation. These are the potential risks. As for all the others, like evaluations, price to earnings, corporate profits, the labor market softening, all the known risks, which, by the way, as a gentle reminder, those are not the ones which are going to crash the markets. The market can only crash out of an exogenous event because all these risks, they are known. So it's always the unknown which crashes the market, the proverbial black swan. Those are all what would Nassim Taleb call them? The gray swans, something like it. So again, just keep your cool. The market, it's gonna do what the market always does, and just don't try to call for tops and bottoms as usual. All right. And with that, I think this is it. I mean, it gotta be it because it's too fucking long. So have fun this weekend. Have a good Sunday, and as usual, be nice and be cool. Neil's out.
Yeah. Money never sleeps, pal. Just made 800,000 Hong Kong gold. It's been wired to you. Play with it. You done good, but you gotta keep doing good. I showed you how the game works. Now school's out.
Mr. Gecko, I'm there for you 110%.
No. You don't understand. I want to be surprised. Astonish me, pal. New info. I don't care where or how you get it. Just get it.